Good afternoon, everybody. Welcome to today's live Interactive Brokers event. My name's Andrew Wilkinson. Back with me today is Dan Sheridan at Sheridan Risk Management. How are you, Dan?
Oh, doing good, Andrew. Welcome, everybody.
Thanks, Dan. And you're going to be talking about the options wheel strategy. Tell us about the options wheel before we begin.
Yeah, and the wheel has been around a while, and it's basically describing the process that, excuse me, a lot of retail traders use for like covered rights and stuff. So the wheel starts with, and I'll go over this in a second. It starts with somebody might sell a put in a stock they like, sell a put below the market, and they're happy to just collect that income or premium every month. But because it's in a stock they like, if the stock goes lower and they get assigned in the put, they're happy to be long the stock because they have a long-term investor approach with the underlying. And then when the stock goes up, then they would sell a covered call against it and end up in a covered right. So they would maybe go from a cash secured put to a covered right. And eventually on the upside, if they get assigned on the short stock or in the short call, it takes out your long stock and then you're out of everything and you could start the process again. So it's this process that describes starting with a short put, get assigned on the put, long the stock goes up, sell a call, you eventually get called out on your stock by getting assigned on the short call, and you could start it again. So that's what they call the wheel, and that involves really two of the more popular strategies. I'm sure you see at IB a lot, Andrew. People might call it on the put side, a cash secured put, selling a put because they want to buy the stock, but they have to have enough money in their account to buy the stock, or a covered right. Many people have come into the options market via the strategy covered right, just trying to get a little more income on the stocks they own. So that's what we're going to kind of jump into today. As my Irish grandmother would say, to make a long story short, but that might have been a little bit too long. But thanks.
It sounds a little bit like having your cake and eating it, Dan. We're going to go into that shortly. I've just put up on the screen the disclosures from Interactive Brokers. We're talking about options, potentially risky products. Please do take a moment to read it. Today's presentation is also embedded in the handout section of the GoToWebinar software there, so please expand that. If you want to download the handout, expand the handout section, click on the link, save it to your hard drive, and you can run alongside Dan here. And we'll also put a link to the handouts on the website later today. You'll receive an email from us from GoToWebinar saying that your recording is ready, so you can go and download all prior, well, you can go and download, review today's session and any prior webinar sessions we've run with Dan and any of our other co-sponsors. And we'll try and leave room for Q&A towards the end. Dan, I'm going to make you an organizer so that you can ask questions and see them. Hold on 1 second, sir. And Dan does like to ask a lot of questions of the audience, so please do play along and use the chat panel to put in responses to Dan as we're going through this. And you can use the same chat panel to put any questions in that you have for Dan. So Dan, with that, I'm going to run the slides for you. There's a handsome gentleman up there. Don't know who he is.
It's a few years ago.
And there's your disclaimer, Dan. And I'll hand over to you.
Thank you, Andrew. Appreciate everybody coming in today. Hope you're all doing well. And all right, Andrew, let's go to the next slide. We'll keep it there for a second. How many of you have heard, just to get an idea here today, how many would say, Dan, I've heard of this wheel concept, the wheel strategy? How many have heard of that? How many would say yes? Yes, I've heard of it, or no, I haven't. And, you know, again, in the conventional wheel strategy, and I'll go through this relatively quick, on the conventional wheel strategy, there's two pieces of it in the conventional wheel strategy. you sell a put for monthly income in stocks you like. And you collect the income over and over. And if the stock goes down, you get assigned on the short put and you end up buying stock at a lower price in stocks you like. How many have done that part of the wheel in the past or consistently? Selling the terminology would be a cash secured put. How many sell puts every month in stocks or ETFs they like for monthly income? But if the stock goes down and they get assigned, they're thrilled to buy stock because they have a long-term perspective. So some folk, like Alice, some folk do the short put. Now, the other piece of the wheel strategy is, hey, I start with a short put. And again, I think in the real world, some people may just do short puts. Some people may do more covered rights, but some do both. How many would say the part of the wheel strategy, how many people do covered rights, long stock, short to sell out of the money calls for a little extra income? And the idea with a covered right is, I'm long 100 shares of Apple. I sell an out of the money call. It could be a week or 2 weeks or a month out of the money. And the goal is to have your cake and eat it too. Make money from appreciation on the long stock, and also that the stock doesn't go up too fast past a short call, and I collect that premium as well. How many do that piece of it? All right, so there's a couple pieces here. And today, so that's the traditional. So the slide you're looking at now is your traditional wheel strategy. And how many of you would say, Dan, the way I got into the options business is maybe somebody told me about covered rights or selling puts, and that is really how I got maybe into the business. How many of you would say that has been your bridge into the options world via the covered right? Hey, you had long stock and you sold a call. Someone told you about that, or someone told you about this concept of selling a put to buy stock at a lower price. How many would say that was my bridge to the options world? Anybody? All right, so let's go through this. So the slide that you're looking at here is basically your traditional wheel strategy. You start out, sell puts, collect the premium. If you go to the right of this, maybe Andrew, do you have your dancing red ball, I call it? You start with the short puts, you go to the right, if assigned on your short put. If it goes below the strike of your short put, then you get long stock. And then as the stock starts going up, you could sell some calls, out of the money calls against it for some extra premium to add on to your long stock. And then if you go to the next step, if you're assigned on your short call, your stock gets called away, you've made money because the stock has gone back up, you've made money on your long stock, and you might have even made money on your short calls. And then you restart the process. And in that restart, you could wait till it goes down a little bit or whatever, but it's that process. And so, and again, some people may do one part of it, some people may do both, but that's the traditional wheel. So if you go to the next slide, Andrew. So 4 problems with the traditional wheel strategy. And again, I'm just, I'm not saying it's bad to do, I get it. A lot of people who do covered rights, many of you, right? You might have been long a stock for 25 years, right? So you're fine with that, and you don't want to sell it out, whether it be taxes or whatever reason. And so, and you just sell calls against it, right? But so there's nothing wrong with, a lot of people are long stock, but I'm just coming at it comparing, just pluses and minuses. So cost, anything that involves stock is expensive. Would everybody admit, right? Anything that involves stock is relative, it's expensive, especially as you compare it with options. So yield, anything that involves expensive stock ownership will lower your yields compared to all option strategies, just because the options are cheaper. And we'll get into that in a second. Now, I could have been gentler here. It's not, I would say, not, again, not good for small accounts because of stocks high cost, right? If you do, if you do, would everybody admit this? If you do let's just take any stock. Let's just say we take Tesla's at $341. It's up $12 today. It's finally rebounded. But basically, if you do one covered right or cash secured put in Tesla, it's going to cost over $30,000, right? You either got to buy the stock, which for 100 shares of Tesla at 341 would be over 30 grand, or if you sell a cash secured put, even if you bring in $3 on the put, you still got to put up $30,000. Do you agree? Because of the cost of the stock. If you did it in Microsoft, if you wanted to do a covered right in Microsoft, it's over $400. You're going to spend $40,000 to buy 100 shares of stock. And if you do cash secured, if you do puts, you're going to sell a put in Microsoft for $2 or $3 or $4. You still got to put up $40,000 or so. Does everybody understand that? That would be margin. And even if you have it in your account, right, you have to allocate capital towards that. Does everybody know that? Carrie says, when I'm selling cash secured puts, if I average in on the puts while the stock price goes below my strike price, for example, I sell a put at 21, then sell another put at a 20 stock price trading, and then I get assigned on the put, do I get shares based on the average price of 20? I mean, you're going to get assigned carry on every, whatever strike price you sell, right? Less the premium. That will be your price, but you're getting, it would be each strike, right? Each strike that you're selling less the premium. So, if you're selling puts at lower and lower strikes, you're just lowering your average cost, right? So not good for small accounts because of stock's high cost, risking too much capital in your account as you get older, right? You have a lot of money allocated to this, and I think so. I'm going to introduce this webinar on deal with the cash secured put, cash secured puts, and then next webinar I do, it'll be a part 2. I'll deal with covered rights and give you basically, today would be a cash secured put alternative and how I would do it in the wheel. And also I would give the covered right alternative next thing. I've just recently done it, I think maybe in November, December, I did a course on this new wheel strategy. Andrew, if you go to the next slide. So there's a lot, folks, I'm just going to give you the basics so we can jump in today, but there's a lot behind it. But I'm proposing for, let's just say, how many might say, Dan, I'm long Apple, or I'm long SPY, or I'm long this in my retirement account. It's pretty expensive. I'd like to buy some more stock or whatever, but it gets a little expensive. This is just maybe another way of, if you want to do additional type covered rights or cash secured puts, a cheaper way to do that. Okay, so that's really my goal today, is to share. It's not saying, conventional covered rights and cash secured puts are bad. It's just saying this is just a cheaper way of doing it. So it just gives you gives you a choice or an option for if there's stocks or ETFs that you like, and maybe you don't have 50,000 sitting around. This is a way to participate and basically in many ways duplicate it. So instead of selling a cash secured put in the traditional way, we're going to start out with selling a put spread. And I'm going to give you an example. It's just doing a put credit spread. And it's basically saying, hey, if you're selling an out of the money put for $3, I'm just telling you, go in and buy a out of the money put at 20 to 25% of the value of your short put, and you'll reduce your margin a ton. Your potential yield will go up quite a bit. So if I sell something at, let's say $4, I sell a put for $4, 25% of $4 would be $1. Go buy a put out of the money at $1 or 80 cents, right? Does everybody get that concept? Yes or no? Does everybody get that, what I'm proposing in this first step, sell put spread? Does everybody, yes or no? I understand. Dan, you're just saying instead of just selling a put, like a cash secured put, naked, I mean, you're going to have a lot of money that you're going to have to put up for that. Buy a cheap put against it for 20, 25, 30% of the value of the short put. How many say I understand that? Yes or no? Does anybody understand that? Yes. Right? So that's all you're doing. I'm just saying it costs a lot of money to sell a put when there's no hedge there, right? Now, as long as you have a lot of money in the account, and I'll show you, you know what, Bernard, we'll have an example here. So sell a put spread, and I'll just go through this part pretty quick. Sell a put spread. So I'm selling a strike, I'm selling a put, buying a put underneath it. That's called a put credit spread. That's all it is. I'm selling a put credit spread instead of a short put. If I get assigned on the short put, right? So again, but I'm putting up so much less money. I'm putting up tremendously. So basically the cash secured put becomes a put spread. Now, here's the neat thing. The put you're buying against your conventional short put is very far out of the money. It might be a delta of 5 or 7. So there's just a small possibility that will come into play, right? So if you want to go your same thing, okay, I get assigned on your short put. But what happens when you get assigned on the short put? What does that short put become? I'm going to give an example in a second. What happens when your short put gets assigned? What do you find in your account? What appears in your account when you get assigned on a short put? Stock. What kind of stock? Long stock, right? So you get assigned on 100 shares of stock, right? And there's a lot of logistics to this, but let's say you're long stock. Long stock, again, eats up a lot of money. So you could sell out the long stock, but I would close the short put before I get assigned. But the bottom line is I'm going to replace that long stock with an in the money call, right? An in the money call, it could be 100 days out, it could be 2 years out, maybe an 80 delta call. Why would I do that? Why would I replace my long stock with an in the money call? Something that would replicate, that would be pretty close to replicating what a long stock does on the upside. Why would I do that? Why would I tremendously reduce costs? So I buy an in the money call, And again, if you get assigned on a short put, it's because the market's gone down. So now I'm long the in the money call in the conventional covered right, your long stock. And then the market starts going up, right? As the market starts going up, I can sell calls against it. What's that called in the options world? If I'm long an in the money call, let's say a year out, and I sell an out of the money call against it. In the world of options, what do they call that? You can call it a poor man's covered call. You can call it a long diagonal, but it's a diagonal type spread, right? It's much cheaper than a conventional covered call. And because it's much cheaper, it gives you a much higher potential yield. So then I have this in the money call, we go up, right? I sell calls, out of the money calls against it. If I get assigned on the short calls in the conventional wheel, it takes out my long stock. But what happens if I get assigned and I'm long and in the money call, and if I get assigned on my short calls, that could turn into short stock. I don't want the short stock. So I would buy the short calls in near expiration and then sell out my in the money call, and then it would be closing it out. Now, again, for those of you, if this is the first time you're hearing this, it might be a little bit different, but it's pretty easy like anything else once you get used to it. But that's the basics of it. Maybe another time I could get a little more of the logistics. Andrew, let's go to the next slide. You know what? Here's just more in detail. I'll let you have the slide on this. This gives you a little more detail, right, of the what I just went over. So I'll let you look at that, and let's run into an example. So XXYZ, I think I meant to do XYZ, but XXYZ is good too. A cash secured put. So this would be a put. A typical example of I'm going to give you an example of a cash secured put and then what I would do. Okay, so cash secured put is this. I sell one Feb 28 225 put at 250. So let's say the underlying is $231, right? And along that axis, so 231, and we're selling a put at 225 strike for $2.50. So what does that mean? It just means as long as we don't go under 225, I get a check for $250 every time I do it, right? So I'm selling a put below the market at a strike that I don't think the stock will go. And you can do this every 2 weeks. You could do it every month. You could do this every week, whatever. So is everybody with me so far? I'm bringing in $250. I'm selling an out of the money put. If we go below $225 at expiration, if we held it that long, I'm obligating myself to buy 100 shares of this vehicle at the strike 225 minus my premium of $250. That would be 222.5. How many are with me on that? Right, so that's this short put. The problem is I've got to put up a margin of 22,500. So I'm bringing in $250 of premium, but I've got to have 22,500 allocated to that. So what would be the yield on that? $250 divided by 22,500, 0.01. That's not horrible, but is that, how many would say, over a, close to a month how many would say that's a great yield? Yes or no? 0.01. How many would say that's a great yield? Right? It's nothing to write home about, but typical on these strategies, whether it be covered right or cash secured put, I would say historically, maybe 1% a month would be reasonable. Would you guys agree with that? Now, it depends on the vehicle. It depends on the vehicle, but I think historically those are decent numbers. So all I'm saying is this. If you go to the next slide, Andrew. Yes, Sarkis is like, I'm sorry, 0.01 would be 1%. Yeah, it'd be about 1%. Thank you on that, Sarkis. And so, so all I'm saying here is I'm going to sell one Feb 28 225 put for $2.50. Generally, when I'm doing a cash secured put or this cash secured put alternative as a general guideline, it depends on the vehicle, whether I'm doing SPY or Tesla or Apple or Costco. Yeah, it depends, right? And you know, the premium levels, the price of the underlying. But here, generally a 20 or 30 delta put is what I'm using to pick the short strike. How many are familiar, yes or no? Dan, I am familiar or I'm not familiar with using a delta to pick my short strike in a cash secured put or some type of strike. Yes, Dan, I'm familiar with that terminology, yes, or no, I'm not familiar with that terminology to use a delta to pick a short strike. So it's basically saying this. There's many different definitions of the word delta, but one of them is a 28 delta would mean this. There's only a 28% probability that whenever the day I took this slide, right, it's saying there's only a 28% probability that by the Feb 28 expiration, right, let's say this had 20 days to go or 25 days, that we're going to finish under the short strike. There's only a 28% probability that we're going to finish under the 225 strike. So what does the flip side mean? The flip side means there is a 72% probability that we're going to finish over 225 at Feb 28 expiration, and I'm going to collect the whole 250. You see that? So there's only, so that's from a probability. So here, I'm saying if selling one Feb 28 put on a $220 vehicle, I'm going to have $20,000 or something in my account. What's a cheaper way to skin the cat? And so I'm looking at the cost of my short put, and I'm going to take somewhere in the area of 15 to 25% of that and go buy a put. Generally, it'll be in the area of a delta 7 or 5 or something. So here, I'm just buying, and really I'm buying this put by one Feb 28 210 put at $50, $50. And it's a hedge. Why am I essentially buying it? I'm buying it because it reduces my margin on the short put from 20-some thousand to $1,300, and I'll explain that. So I'm just buying this little cheap put to reduce my margin dramatically, and my yield goes up. So what is, in the options vernacular, what spread did I create? In the world of options, what did I create? What is this called? Yeah, interactive brokers, in the world of options, what are different names for this? This would be a vertical credit spread, a put credit spread, a credit spread, a could it be a bull put spread? If you have another name and you'd like to tell me, but it's a put credit spread, a vertical credit spread, a vertical put credit spread, a bull credit spread, a bull put credit spread. All right, so we got the terminology. Once you're in the world of a credit spread, there's some defined rules, isn't there? There's some defined rules. There's some defined rules. What are the rules? What is the risk of this trade? The risk of any credit spread is the difference between the strikes. In this example, 210 and 225, the difference in strikes is 15. So the total risk in this trade is $1,500 less the credit of 15 cents of, less the credit of $2, my short put of 250, my long put of 50. So it's the difference in strikes, $15 minus $2. So now my risk, my margin is $1,300. That's it. That's the only dollars that I have allocated to this, not 20,000, 1,300. So instead of making $250 on 20-some thousand, I have the potential to make $2 on 1,300. Does that sound like a better deal? Yes or no? Would you rather make $250 on 22,000, A, or B, $200 on 1,300 potentially? What do you think? What do you think? Yeah, I mean, there's no comparison in terms of that. Now, so the yield, again, I'm just looking at potential yield, $200 divided by 1,300 would be 15%. You agree? And again, there's more to it than that in terms of a discussion on credit spreads in general, but so that's what a credit spread looks like. If you look at the green graph there, and Andrew could show that, that's the expiration graph, what the graph looks like at expiration. So you could see you have, you know, on the upside, you can make your credit. On the downside, you have a max loss there of that $1,300, right? That's your max loss. The purple line there would be how the graph looks like today, you know, the day I put it on. So that's called like a T+0 graph. That's how your graph looks the day you put it on. The green graph is what the purple graph morphs into as time passes. And you could get into managing this, but that's kind of the gist of it, right? That this, you know, is as part of this new options wheel. This is a much better way to do it. Now, obviously, you can make that credit spread a little wider. You can make the credit spread a little narrower. There's different things you can do on that. Have any of you ever tried something like this? Have any of you ever tried something like this? A credit spread, just a put credit spread. Have any of you done anything like this? Yeah, and I mean, yeah, so it's just, you know, it's basically, you know, and I would encourage, you know, to practice, even do it on paper for those of you who are used to selling puts. I mean, the concept isn't that difficult, right? You're just buying a cheap put, so you don't have to put as much capital with it, right? And then you could get into, you know, I mean, we talked briefly about it, but if you have a put credit spread on, there's different ways to manage this, right? If my, there's two lines of ways that I would deal with this. Trader A, right? Let's say Daryl or Eduardo or Martin says, hey, Dan, maybe I want to, I like doing that cash secured put thing, right? But I would just like to stay in that stage and just get monthly income, right? I don't, I like selling a cash secured put. I like getting the money. I know the yield's a little less, but I'd like to just stay in that stage and get monthly income and do put credit spreads and stocks I like on a monthly basis and just stay in this stage. Then it would just be, you can just do the put credit spread. You don't have to worry about assignment. You could just treat this, as a spread. You might say, okay, it's a $1,300 spread, $1,300 of capital. My goal is to make 10% on this, 10% of the $1,300, $130 on this trade, or whatever the risk management is. And then if it goes, there's no risk on the upside. If it goes down, you could do some type of adjustment. You could close it off. That would be maybe we'll have to add a third webinar, which would be managing once you get into the credit spread, or managing the long diagonal, which would be the covered right alternative. But the main thing I want to introduce to you is, that's the wonderful thing of options. Options, you think about it, were options invented? Do you think options were invented to make life and investments riskier? What do you think? Did the people who invented options, stocks existed, why do you think they invented options? Anybody have any idea why? Why they were invented at the Chicago Board of Options Exchange in 1970? Anybody have any idea? Hedging. It wasn't to create an exchange for crazy wild people. It was hedging things, right? Reducing risk, right? So that's all this is doing, is limiting one's risk. And so this also allows you, especially as you're getting older, to have a lot less money at risk, right? I've got to sell a out of the money put. I've got to have all this money in the stock. I've got to have all this money into all this money on the side to invest in stock. Credit spreads are a wonderful way to do it. So, what I'll do, Andrew, if anybody's got any, I can work through some of these questions. If you have any questions, again, I just kind of introducing this. Next time I'll talk on covered right alternatives, and then maybe one more webinar. How would I manage these types of trades? A question came, if I'm assigned at 225 on the short put, do you have to then sell at 210 because you own a long put, and so you lose the 1,300? All right, so here's the thing. So let's say we go down on this strategy. All right, we bought, how much did that put cost us? How much did that put cost us to hedge this? How much did that long put cost me to hedge this thing? $50. That's it. $50, right? For $50, I basically eliminated the need, right? For $50, I eliminated the need to hold $20,000 in an account. Is that pretty good? I call up Interactive Brokers. I'm joking here. By me putting a $50 hedge, they say, okay, you don't have to put up $20,000. How many would like that? How many would like that? That you can, for 50 bucks, eliminate the need to put up $22,000. I think that's reasonable, right? Unless you're just, you just have so much money around, you don't know what to do with it. But if I get assigned on the put, again, one approach. So let's say approach number one, Daryl says, you know what, Dan? Daryl says, I like putting up less money. Okay. We go below 225. In your typical world of cash secured put, you just take assignment still. In your typical world of cash secured put, if we go below 225 to 220, could you still just say you're just going to get assignment and you're going to be long 100 shares of stock? If we close at 220 at expiration, you're going to buy 100 shares of stock at 225 minus 250, right? That would be 222 and a half. And your long put would go out worthless, and it would be like normal, right? That's one approach. Agree? How many get that? Because the long put's so far out of the money, right? You're just going to get assigned on your short put and it turn into long stock, right? And if you don't like the long stock, you could sell it out, which I would, but and just be long and in the money call. But that's one approach. The other approach is you manage it like a credit spread. And if I have a credit spread for $2, as we start going down, I can roll the spread out further and lower. I mean, there's things I can do. In other words, if I have this put credit spread, am I going to wait till expiration? No, I'm going to try to make my money before that. I'm going to manage the credit spread. And that would be in the third webinar. I'll get into managing these things. So I think it's part of this is seeing what's your purpose, right? The bottom line, what I'm introducing today is if you choose to have a lot less money committed, and basically, think about what we said at the beginning. Trader A can make the cash secured put of $250, right? And if we go up, he makes the whole 200. If it doesn't go below the short put in a typical cash secured put, you get your $250, but you have $22,000 committed. Scenario number two is Trader B says, I'll settle for $200, but I'm only putting up $1,300. That's all. So it's you're basically making this close to the same amount for much less capital. So I'll tell you what, if you have any other questions, you can email me, dan@sheridanriskmanagement.com. Again, the next webinar will be on the covered right alternative, and then I'll do a third webinar on kind of tying it all together. Well, how do you manage these things? Dan, what are you proposing? How would you manage a credit spread? How would you manage a diagonal? What if the stock goes down? What would be your game plan? And I can give you that. Okay, here's a note. As I said here, the cash secured put alternative I used is a put credit spread. The risk of a put credit spread is the difference in strikes minus the credit, which we went over. The most you can make is the credit. The class example was to sell one Feb 28 225 put and buy one Feb 28 210 put for a credit of $2 or $200. The risk, if I did nothing, the risk is the difference in strikes. 225 minus 210 is 15, minus the $2 credit, or 13. You can reduce your risk in credit spreads by narrowing the put credit spread width, which we talked about. The $1,300 margin in this example is compared to the nearly $22,500 of risk in selling a short put for $2.50 with a strike of $2.25. Because technically, you know, if you're just selling a cash secured put and the stock absolutely tanks, you know, you have quite a bit more risk than a credit spread. So anyways, I hope that gave you at least some thoughts. We'll delve more into this. Yeah, you know what, Nicholas, the next webinar will be how we end up in this. I can make it just a point on it, but how we end up. Andrew, maybe bring up that right. Go to the slide like right before the cash secured put. So if you look at, yeah, right. You know what? Go one more before that. Cash secured put. How about before that? Perfect. Perfect. So if you look at, Nicholas, if you look at step one, you have this, instead of doing the cash secured put, you're doing a put spread, which we talked about, buying an out of the money put. Step two, if assigned on the short puts, right, and you get long stock, you could sell the stock and replace that with step three, buy the in the money call. What I would do, Nicholas, is before, and there's ways to know this, but before you get assigned on the short put, I could buy it back, buy back my short put, and then buy the in the money call. All right. Let me just ask a question here. How many of you, is there a way to, in most cases, is there a way in most cases to know when you'll get assigned on a short put? Yes or no? Is there a way to have a decent idea when you're going to get assigned on a short put? Yes or no? Or a short call? What's the answer? Anybody? What's the answer? Whether you're short a call or short a put, but especially, you know, short a call, when is a, how many of you are familiar with the word, with the term extrinsic value? How many of you are familiar with the term extrinsic value? Yes or no? Deanna, I'm familiar with the term extrinsic value, right? Right? That's juice or time premium. So when an option, maybe it's easier to understand in the calls, but in the puts, when a put goes in the money and the extrinsic value is, there's no more, when it kind of goes to zero, that means you're getting close to expiration and someone will assign it. But let's say you're short a in the money call, right? And there's $2 of extrinsic value because there might be 30 days left or 20 days left. No one in their right mind, unless it's a huge dividend, no one in their right mind is going to exercise that call. And that's the same with a short put. As it goes in the money, if you're aware of the extrinsic value, when that disappears or gets a lot less, that's when you're going to be exposed to an assignment, right? So it's this, you know, it's not a mystery type thing, right? It's something you can watch for. So again, if you have any question, you know, what you can do is, if you have any questions on this, what I'll do is, I may answer the question, but I'll accumulate these, and maybe I can quickly at the beginning of the next webinar that I do next month, answer some of these, because I think some of them will be similar questions on this all-wheel strategy. But today was just focusing on a more effective, efficient way to sell cash secured puts. There's more to it. We had a limited amount of time today. But so anyways, well, folks, thank you. I have a date already set for the second webinar. The third one I don't. I just thought of today it might be good to do one on, well, how do you manage these two spreads that you're going to end up being in? And I can give you a simple methodology for doing that. So there is maybe Andrew could help with that. The second one that I'll be doing, what is this, in March, and then I'll try to get something up for April. But thanks everybody, I appreciate it. Thanks Andrew, as always, and we'll see you guys next time.
And thank you very much indeed for joining me today. And have a look under the education menu at the IBKR campus, and specifically to webinars, and you'll see a list of all events that are scheduled to come out. You can also look at the recently aired webinars and find Dan's prior recordings with us. A couple of hours from now, you'll receive a link to today's recording. And Dan, thank you very much. We look forward to speaking to you again in March. Thanks, everybody. Bye for now.